There's an old saying in trading. There are old traders and there are bold traders, but there are very few old bold traders. When you first sit in front of the charts, it is easy to believe that bigger risk means bigger reward. You think if you swing harder, you will win bigger. But after years in this game, I can tell you this clearly. That belief destroys more accounts than bad analysis ever will. Most traders do not fail because they cannot read the market. They fail because they risk too much. You have probably heard the rule before. Only risk 1 to 2% of your account per trade. And when you first hear it, it sounds boring. You think, I did not come into trading to play small. I came here to make life-changing money. I understand that feeling. But here is the problem. If you risk 10% of your account on one trade, then 5 losses in a row can cut your account almost in half. And 5 losses in a row can happen to any system, even a good one. Once your account is down 50%, the damage is no longer just financial. It becomes psychological. You stop thinking clearly. You stop looking for good trades. You start trading only to get your money back. That is when the real danger begins. Now compare that with a trader who risks only 1% per trade. 5 losses in a row means they are down only 5%. They may feel annoyed. They may feel frustrated, but they are still calm. They are still thinking clearly. They are still in the game. One trader is panicking and trying to survive. The other trader is still playing to win. That is the entire difference. And the math makes it even more brutal. If you lose 50% of your account, you do not need 50% to recover. You need 100%. You have to double your remaining money just to get back to break even. But if you lose 5%, you only need a small gain to recover. One trader needs a miracle. The other just needs one decent trading week. This is why aggressive trading is not confidence. It is often just a mathematical trap. Look at Jesse Livermore. In 1929, he became a legend by shorting the stock market before the Great Crash. He made the modern equivalent of around $1.5 billion. He was one of the most famous traders in the world. But a few years later, he declared bankruptcy. How does someone go from legendary wealth to completely broke? The answer is simple: position sizing. When Livermore felt certain, he bet too big. He confused a winning streak with invincibility. He believed the normal rules of risk did not apply to him anymore. The market punished him. He did not lose everything because he lacked talent. He lost because he could not control his size. That same monster destroys retail traders every day. The problem is not always strategy. The problem is survival. And the reason traders keep making this mistake is psychological. When you risk big and win, your brain gets a huge dopamine hit. You feel like a genius. You feel unstoppable. So on the next trade, you size up. Then the inevitable loss comes. And losses hurt more than wins feel good. Now your brain screams at you to make the money back immediately. So you increase size again. You try to recover everything in 1 or 2 trades. That is revenge trading. And revenge trading is where most accounts go to die. It is not caused by one bad setup. It is caused by a position size your nervous system cannot handle. Safe trading removes you from that nightmare. When you risk 1%, a loss is not a life event. It is just a normal business expense. You do not spiral. You do not panic. You do not chase. A win feels good, but it does not make you feel invincible. A loss feels bad, but it does not destroy your mind. You stay rational. And in trading, rationality is everything. Let me give you a simple example. 2 traders start with $25,000. They study the same strategies. They watch the same videos. They trade the same markets. But trader A wants fast results. He hates his job. He sees trading as his escape. So he risks 5% per trade. At first he feels powerful, but after a few bad weeks, his account drops badly. He cannot sleep. He checks his phone constantly. His mood changes. Trading is no longer improving his life. It is destroying it. Trader B takes the boring path. He risks only 1.5% per trade. Trader A mocks him and says he is trading too small, but Trader B does not care. His only goal is consistency. 6 months later, Trader A is emotionally exhausted and financially damaged. Trader B has grown his account steadily. Nothing explosive. No huge screenshots. No dramatic wins. Just controlled growth. More importantly, Trader B sleeps well. His worst drawdown is manageable. He still trusts his system. A year later, Trader A quits and says trading is a scam. Trader B keeps trading. 5 years later, Trader B manages a 6-figure account. Same market, same starting capital, different position sizing, completely different life. Now think about March 2020. Markets were moving violently. Stocks were gapping. Volatility exploded. Stops were slipping. If you were risking 10% per trade, one wrong move could damage your entire account. Some traders lost 30 or 40% in hours, but traders risking 1% could survive. Yes, they took losses, but the losses were manageable. And that is the key. Because after the crash, the recovery created some of the best opportunities in history. The traders who survived had capital ready. The aggressive traders were already out of the game. They had no money left to use when opportunity arrived. That is the truth most beginners miss. The market always creates opportunities, but you can only take them if you survive long enough. Professional traders understand this. Most serious institutional traders risk between 0.5% and 2% per position. Some hedge funds risk even less. These people have better data, better tools, better research, and more experience than most retail traders. Yet they still keep risk small. Why? Because they know one truth. Staying in the game is more important than any single trade. Survival comes first. Profit comes second. There's also another hidden cost of aggressive trading: time. When you lose half your account, you do not just lose money. You lose months or years of recovery. If it takes you 2 years to rebuild a blown account, you have not just lost capital. You have lost 2 years of compounding. You have lost 2 years of opportunities. Aggressive trading steals time, and time is the most important ingredient in building real wealth. Many traders argue, but what if I catch a huge winner? Yes, if you risk 10% and catch a 10-to-1 trade, you can double your account. But here is the problem. You may not survive long enough to see that trade. Before the big winner comes, there will be losing streaks. There will be bad weeks. There will be choppy markets. The aggressive trader gets eliminated before the best trade appears. The safe trader survives long enough to benefit from it. That is why boring risk management creates exciting long-term results. I once watched a trader in a Discord group start with $50,000. He was talented. His setups were clean. In 2 months, he grew the account to $71,000. Then ego took over. He started saying he had figured out the market. He increased his risk to 8% per trade. Then came 5 normal losses in a row. His account dropped fast. He panicked. Instead of reducing risk, he increased it to 15% to recover faster. Then came more losses. Now he was desperate. He abandoned his strategy and started taking emotional trades. Within 6 weeks, his account fell from $71,000 to less than $3,000. Then he disappeared from the group. The sad part is that he was not bad at analysis. He was good at reading charts, but none of that mattered once his position size triggered a psychological death spiral. Big size creates big losses. Big losses create panic. Panic creates even bigger risk. And bigger risk creates destruction. The safe trader never enters that cycle, because no single trade has the power to destroy them. That is real freedom. When you know that one trade cannot hurt you, your execution improves. You stop hoping. You stop praying. You stop moving your stop loss. You stop staring at every candle like your life depends on it. You simply follow the plan. Take the trade. Accept the outcome. Move on. That psychological calm is a real edge. Your entries become cleaner. Your exits become better. Your decisions become more objective. The aggressive trader cannot do this. When 10% of their account is on one candle, they start seeing things that are not there. They exit winners too early. They hold losers too long. They trade from fear, not logic. Even when they win, they reinforce bad habits. Over time, the difference becomes massive. One trader becomes calm and consistent. The other becomes anxious and impulsive. Think about Warren Buffett's famous rule. Rule number 1, never lose money. Rule number 2, never forget rule number 1. It sounds simple, but that mindset is why compounding works. He does not try to hit a home run every month. He focuses on not striking out. Because if you avoid destruction, time can do its work. Now imagine a realistic path. You start with $10,000. You are not a genius trader. You simply respect risk. You risk 1% per trade. Some months you make 3%. Some months you make 8%. Some months you break even. Some months you lose a little. But overall, your equity curve rises. Year 1, maybe you reach 14,000. Year 2, 20,000. Year 3, 30,000. Year 4, 47,000. Year 5, 75,000 or more. That is not lottery money, but it is real wealth being built. No stress, no blown accounts, no constant restarting. Now compare that with the aggressive trader. Most do not survive year 1. They blow up, restart, blow up again, and spend years learning the same lesson. Meanwhile, the safe trader keeps compounding. The game rewards the person who keeps showing up with capital, not the person who occasionally shows up with huge risk and a dream. I will leave you with Marcus. Marcus was a smart engineer, very analytical, very disciplined in other areas of life. He started trading with $75,000, his life savings. Because he trusted his intelligence, he risked 7% per trade. At first it worked. His account grew to $91,000. He started talking about quitting his job. Then reality hit. A few bad weeks wiped out all his gains and pushed his account down to $54,000. He reviewed every trade, searching for the flaw. But the strategy was not the problem. His entries were fine. His analysis was fine. His position sizing was the killer. He took a month off. When he came back, he lowered his risk to 1.5% per trade. At first, it felt painfully slow. No huge wins. No exciting screenshots. No one was impressed. But he became consistent. 3 years later, Marcus had grown his account to $286,000. He quit his engineering job safely. He trades for a living. He has his mornings free. And he has his life back. He once told me, "I wish I had learned this before it cost me $21,000 and a month of psychological stress. The strategy was never the problem. My ego was the problem." And that is the lesson. Trading is not about being bold. It is not about proving how confident you are. It is not about making one massive trade that changes your life. Trading is about staying alive long enough for your edge to work. Because the trader who survives gets to compound. The trader who compounds gets to grow. And the trader who grows slowly, calmly, and consistently is the one who eventually becomes dangerous. Survival is the ultimate edge.